Welcome to Long-Term Yield. This is the channel for investors who believe the best returns come from owning great companies for 10 years or more. No hype, no day trading, just calm, data-driven analysis of one stock every single week. Let's get into today's deep dive. This might be one of the best businesses in all of technology. It's debt-free, it's growing revenue over 30% a year, and it quietly powers a huge slice of everything you buy online. It's also down about 30% this year. So here's the real question. Is this dip a gift? Or are you about to overpay for greatness? Let me give you the shape of it before we go deep. $12.4 billion in revenue, growing 30%, zero debt, and nearly $6 billion in cash. A wide moat, and a price tag of 112 times earnings. Hold that last number in your head. It's the whole debate. Here's how we'll do this. The business and the moat first. Then the numbers, growth, margins, cash. Then both sides of the argument, honestly. And finally, the valuation, and exactly where I'd be a buyer. Stick around for that last part, because with this one, price is everything. So, what is Shopify? At its simplest, it's the plumbing of modern commerce. If a brand wants to sell online, and increasingly in person too, Shopify gives them the storefront, the checkout, the payments, the shipping, even small business loans, all in one place. They don't sell you things. They power the millions of stores that do. Picture the scale of that for a second. Not one store, millions of them. A whole economy running quietly in the background of your everyday life. The money comes in two streams. Subscription solutions, the steady monthly fees merchants pay to be on the platform. That's the predictable recurring base. And merchant solutions, payments, shipping, lending, which earns a cut every time a store makes a sale. That second stream is bigger, faster growing, and it's the real engine. And the scale is genuinely staggering. 5.6 million active stores, over $280 billion in goods sold through the platform every year. 150 million people have a ShopPay wallet. This isn't a startup hoping to win. It already won a big chunk of the market. How dominant? Shopify runs somewhere between 22 and 28% of the world's e-commerce platforms, and close to 30% in the United States. Its nearest rival, the open-source WooCommerce, is around 21, and Shopify keeps taking share. In this market, it's the clear leader, and all of that commerce flows across borders. 175 countries, in dozens of currencies, around the clock. Now the numbers, and they're impressive. Revenue has gone from under $3 billion in 2020 to over $12 billion today, growing roughly 30% a year. Last year alone, it grew 30% to $11.5 billion. For a company this size, to still compound at 30% is rare. This is the part of the story that's easy to love. But growth alone never impressed me. Lots of companies grow and never make a dime. Here's what actually matters. Look at the operating margin. 5 years ago, it averaged under 6%. Today, it's 17%. Shopify stopped just growing and started turning that growth into real profit. That inflection, from break-even to genuinely profitable, is the most important thing on this page. That flows to the bottom line. Net income of $1.3 billion, earnings of about $1.02 a share. One honest note. The headline says earnings fell last year, but that's a mirage. The prior year was puffed up by a one-time tax benefit. Strip that out, and the underlying business is climbing, not falling. Next year, analysts expect earnings to more than double, to $236, and the cash is real. Free cash flow of over $2 billion, a 17% free cash flow margin. Rewind to 2022, and this company was burning cash. Today, it's a cash machine. When a business swings from burning money to gushing it, that's usually the sign of a model that finally works at scale. There's a quick test investors use for software companies: the Rule of 40. Add your growth rate to your profit margin, and if it clears 40, you've got a healthy, balanced business. Shopify lands near 48. 30% growth plus 17% cash margin, comfortably above the bar. Then there's the balance sheet, and this is where it gets almost unfair. Zero debt. None. Nearly $6 billion in cash. A current ratio above 6. A bankruptcy risk score that's basically off the charts in the safe direction. Whatever the risks are with this company, going broke is not one of them. Returns are climbing too. Return on equity and return on invested capital both sit around 11%, roughly double their 5-year averages. The company is getting more profitable on every dollar it puts to work. That's the direction you want to see. And for the first time, they're handing cash back. Shopify just expanded its buyback program to $5 billion. For a company that spent its whole life reinvesting every penny, starting to return capital is a quiet signal of confidence and of maturity. Now, why does any of this last? Why can't a competitor just copy it? That's the moat, the thing that protects the profits. Shopify's moat is rated wide, 8 out of 10, and it's built on 3 things working together: switching costs, network effects, and scale. Let's take them one at a time. Switching costs first, and this is the strongest one, rated 9 out of 10. Once a merchant builds their store on Shopify, their orders, their customers, their product catalog, a dozen connected apps, their staff trained on it, leaving is a nightmare. About 95% of merchants stay. That stickiness is the foundation of everything. Second, network effects. More merchants attract more app developers, which makes the platform more useful, which attracts more merchants. And ShopPay, 150 million shoppers, speeds up checkout, which lifts conversion, which makes merchants want to be there. Each side pulls the other. That flywheel is very hard to stop once it's spinning. Third, scale. With millions of merchants, Shopify negotiates better payment and shipping economics than any small rival could, and spreads its enormous research budget across a huge base. Better checkout conversion, cheaper logistics, embedded financial services. Size itself becomes an advantage that compounds. Put it together, and you get a brand merchant's trust, 95% retention, and an ecosystem of over 13,000 apps that nobody can rebuild overnight. The moat is real, and it's widening. The business quality is not the question in this video, and the whole thing reinforces itself. Every merchant, every developer, every shopper making the next one more likely. There's a newer growth lever worth taking seriously: artificial intelligence. Shopify has built AI tools, Sidekick and Magic, directly into the platform. 42% of merchants already use them, and merchants who do are seeing conversion lifts of 20 to 30%. If commerce is going to be increasingly run by AI agents, Shopify is positioning itself to be the rails underneath it. Think of an assistant that never sleeps, quietly helping millions of stores sell a little better, every hour of every day. Then there's the rest of the world. Through a product called Shopify Markets, a brand can sell across borders, multiple currencies, local taxes, local payment methods, at roughly a third the cost of doing it themselves. Merchants in over 175 countries. International is still early, and it's a long runway. And the app ecosystem keeps the cash flowing. 13,000 apps. Larger merchants run about 11 apps each and spend roughly $42 a month on them. Every app deepens the dependency and adds a little recurring revenue. It's a quiet, compounding upsell machine sitting on top of the core platform. So let's state the bull case plainly. A dominant, debt-free platform growing 30% with a widening moat. An AI edge that could matter enormously. International upside, a fortress balance sheet now returning cash. If you're buying the business, this is genuinely one of the highest quality companies you can own. Everything here is a reason to want it. Now, the other side, because there always is one. The bear case here isn't really about the business, it's about the price, and we'll get to that. But there are operational risks too. Transaction and loan losses inside Shopify payments are creeping up as volume grows. The revenue is tied to how much people spend, so a recession would hit it directly. And competitors on price never fully go away. Every great business carries its own gathering clouds. The trick is knowing which ones are storms and which ones are weather. On competition specifically, WooCommerce is free and open source with 59,000 plugins, and it's a real magnet for cost-sensitive merchants. BigCommerce and Wix compete on price. Salesforce and Adobe fight for the big enterprises. Shopify is winning, but it's not unchallenged, and that keeps a ceiling on how much it can charge. And one number you can't ignore. The beta is 2.6. That means this stock moves more than twice as hard as the market, in both directions. It's already down 30% this year and bounced off $94. If you can't stomach a 30% swing in a quarter, this is not the stock for you, no matter how good the business is. So we come to the only question that actually decides your return from here. Not whether it's a good company, but what it's worth. Here's where it gets uncomfortable. Shopify trades at 112 times earnings, 72 times free cash flow, nearly 12 times sales. By almost any normal yardstick, that is a very expensive stock. At that price, you are not paying for what the company earns today. You are paying for years of flawless growth that hasn't happened yet. But here's the honest twist. The valuation models flatly disagree, and that's the whole story. Against its own history, it's actually cheap. It normally trades near 19 times sales, not 12, and on that basis, fair value screens around 160. But a hard discounted cash flow on the money it makes right now says it's only worth about 80. The blended fair value sits near 134. So is it cheap or expensive? The honest answer? It's cheap only if the growth keeps coming. You are buying execution you haven't seen yet. Let's look at the chart, because it frames the opportunity. After topping out near 180, Shopify fell all the way to 94, and it's been clawing its way back. It's now sitting below its longer-term moving averages, which can mean a wounded stock or a patient setup. Context matters more than the candles. Now the part you came for, where the value actually is. Let me show you the zones I care about, mapped against what the cash flows and the history say it's worth. Here's how I'd think about it. Today, around 116, the stock sits between its cash flow floor near 80 and its history-based ceiling near 160. That's a fair-to-full price. I'd accumulate slowly in the 95 to 115 zone. Below 95, near that discounted cash flow value, is where the margin of safety gets genuinely attractive. That $94 low was the gift. And above 145, you're paying the old rich multiples again. I'd stop adding. And size it sensibly. A quality compounder like this deserves real conviction. But at 100 times earnings and a beta of 2.6, I'd treat it as a 3 to 5% position and scale in over time, not all at once. Let the volatility work for you. With a stock this jumpy, the price you pay matters as much as the company you're buying. So, The verdict: Shopify is a wonderful business at a demanding price. The quality is not in doubt. Debt-free, dominant, 30% growth, a widening moat, and now returning cash. But the market knows all of that, and it's charging you for it. This is not a screaming bargain at 116. It's a great company you want to own at the right price. Be patient, buy the dips, and let one of the best businesses in tech compound for you, without overpaying for the privilege. If this helped you think more clearly, subscribe. That's what keeps these deep dives coming. And tell me in the comments, at today's price, is Shopify a buy? Or are you waiting for a better one? As always, this is education, not financial advice. Do your own research before you buy anything. That's it for today's deep dive. If you enjoyed this video, please hit that subscribe button. It costs you nothing and tells YouTube to send you the next one. And drop a comment below with the stock you want me to cover next. I read every single comment personally, and I cover one new ticker every week. Remember, this is long-term yield, real numbers, real analysis, on real businesses worth holding for the long haul. I'll see you in the next deep dive.